Since 2020, record amounts of capital have continued to flow into the large multifamily space at a record pace and volume. Kyle Agro, with our REIN trusted partner Equiton, joins me to unpack what's behind this growing phenomena and what the doors of opportunity are that it opens for real estate investors. During these unprecedented times, putting our capital to work has to remain our top priority. Kyle shines a light on why multifamily leads the way and the opportunities that it presents for you. Kyle Agro, thanks for joining me. Equiton. Listen, we've got a lot of things going on in the market, so things to talk about. Thanks for joining me.
Yeah, of course. Always happy to be here.
So, Kyle, when we get you on a show like this, it's always good to get your in the trenches experience and what you're seeing happening in the market. You know, when we look at what's happening in Ontario specifically, you know, the word is out, the real estate market's pretty ice cold, especially when it comes to investors. Hard to find deals that cash flow. Lots of word on the street about how much money is flowing into the multifamily space. And of course, that's your backyard. So why don't you give me a little bit, or give our listeners a bit of an update of what you're seeing happen in that Ontario market in terms of investor opportunity, and why Equiton has kind of taken on some of the projects that they're taking on, because you guys are obviously seeing a trend that you want to invest into.
Of course, I mean, there's a large growing trend in terms of how much they're actually building for large scale multifamily. So when we say that, we're saying like 100 units plus.
Yes.
Now, when you're starting to move into that type of a market, it's challenging sometimes, let's call it, for individual investors. And the reason why is because nobody usually has that $20 to $50 million in their pocket to be able to buy some of those big buildings, right? So not to mention, we're seeing less fluctuation in the pricing for these type of assets just because of the way that they're valued. I mean, when you go to multifamily, even on a smaller scale, which is defined as 5 or more units within one structure of a building, it's more the net operating income. So how much revenue you're bringing in versus the expenses that are associated with them. And when you're moving up the ladder in terms of, like I mentioned, how much these assets actually cost, you're starting to get more of those institutional investors who are more looking at this from a numbers perspective rather than single family housing, let's call it, where it tends to fluctuate a little bit more because it's how much people want to pay to live in a certain area. And there's a lot of emotional volatility in those type of assets. So we're definitely seeing that there's a lot of the deals that are starting to come back to the table as well. I mean, when you're looking at this type of an asset class, really, it lags the market a little bit because usually single family homes take on the majority of the, let's call it, clickbait and everything that people are seeing. And these type of assets, because they're run off the net operating income, it takes a while for the prices to actually stabilize within this asset class. So one of the things that we're seeing at this point is it took a lot longer for people who were selling these type of assets to kind of get their feet on the ground, let's call it, when you see monetary policy or interest rates moving as fast and as quickly as they were a year ago or so. So when everything was going up and up and up in terms of that, first things to hit the market, first things to get affected in the market are the single family housing, because those are the things that are being moved around a lot, where these assets weren't. So when that happens, again, you see the curve kind of come down and people are starting to come to terms with how much they can actually sell these for. So having somebody like an Equiton, and what we're looking for, we're not just looking to buy just for the sake of buying. We're not looking to buy to put our families in these things, because it's from an investment point of view. We're expecting for the latter part of this year for there to be a little bit more transactions, because we're going to be seeing more of these deals coming to the table and people with more realistic asking prices, so that we can get involved with more of the due diligence that goes into actually purchasing these moving into the future.
Well, you know, when we look at, and I'm going to have the team put in a chart here, but when we look at what the trend is in that multifamily space, I want to go back to that comment, is that, to your point, I mean, the growth is really in that 100 unit plus in terms of real growth in that multifamily space. Now, to me, that speaks to a couple of things. When you look at the fact that single family dwellings or single family detached dwellings are like flat or on a decline. We're not building enough single family detached. We have these huge amount of immigration coming into this country. So the trend is definitely into that space called we need to supply housing. Multifamily is definitely going to help accommodate all of that. And when we also, I guess, at the end of the day, Kyle, we have to look at who is the demographic that's coming into this country. And that demographic, although maybe not ideal, certainly would be more, have a higher propensity to going into the apartment style multifamily units. And I think that's primarily where the focus is, or is it really multifamily condos? What are you seeing?
Again, I think it's a multifamily apartments, just
Yeah.
like what you were saying. The reality is the federal government is being extremely aggressive with how many people they're bringing in. If you just look at the statistics, they're estimating 500,000 people a year over the next 3 years. And that is a very, very low number compared to what they're actually doing today. Because when you look back at 2022, because we have the full year's worth of numbers at that point, they actually brought in almost 1.1 million people.
Mm.
The reality is, when they say 500,000 people, that's just your permanent residences. What about people coming in on student visas and work visas? That's just as many people coming in through those than it is actually people who are going to live here. Now, those people who aren't going to be here permanently, they're obviously going to be in more of a rental situation. They're not even going to be looking to buying. So that's putting a lot of pressure on the rental market, not to mention even the people who are going to be staying here and are planning on staying here. The reality is, typically for the first few years that they come to the country, they're going to be in a rental situation. So what we're seeing right now is record low vacancies and a lot more pressure on the government right now to get more starts in these large scale multi-family or large apartment buildings, because that's really going to meet the immediate demand of the people who we need coming in.
Well, you make a great point, and which is that when we look at permanent residents or versus, let's say, temporary workers or student housing, when we're starting to look into the demand that's going to be needing to be accommodated, multifamily apartments are in fact the way that that's going to meet the demand. And then when we start to get into those numbers, to your point earlier, for the independent investors to come in and actually trying to find those units, because if big money's flowing into it, that means that the price in terms of even being able to buy those units existing are going to be more challenging to find from an small investor point of view. So in, let's say, anything under 50 units, for example. And then on top of that, as much as CMHC has been accommodating in terms of financing, that's not an easy road to travel either. I'm talking to investors who are looking at months to get deals done, which means you also have to some decent cash reserves to get through that process and be able to get these deals done. Now, let's go back to why I love it when Equiton, as a trusted partner, comes on and speaks to what it is, which is opportunity. There's still huge opportunity for investors who understand that we've got this huge cohort of immigrants coming into the country that need a place to live. Apartment style living is definitely where the demand is. There's a huge volume that has to be accommodated. Equiton has got deep pockets. It's what you guys do. It's your level of expertise. You look into the future. You have a huge track record. So it really is into that space. And this is where the opportunities for investors to get in that don't have to do all the heavy lifting, don't have to chase CMHC financing, don't have to have deep pockets. What they need is a place to park capital into the future. And when I know it's a little bit long-winded, but when I look at real estate in Canada, the fundamental doesn't change. We got huge demand, a limited supply, and we have to accommodate those individuals that are coming in. And let's just take permanent residents, those coming in on a permanent resident visa coming in or wanting to become full-time Canadian citizens. Just the temporary workers and the students alone, those numbers are huge, and those are definitely long-time renters that are always going to be there. That churn is there, and that's what Equiton's got going on in terms of how you approach the market. I know you're working on a project, or you've got a project in the works. Do you want to talk about it specifically, or do we just want to talk about Equiton and all the things that you've done overall, Kyle? I'll throw that, I'll pass that ball to you, and you can run with it the way you want.
The cool thing about Equiton, and one of the reasons why I love working for Equiton, is because we're a full scale real estate investment company. And what I mean by that is we have a few different portfolios that investors can get involved in, really depending on the risks that they want to take on, number one, how long they can leave their money in some type of an investment, as well as what's going on in the market. Now, if you're looking long term, I do still like the buying market. I do still like the condos if you're buying into a development now. And when I say buying into a development now, I don't mean buying into a condo. I mean, like buying an actual unit in the building. I mean, getting involved with the development as a whole. And the reason why I like that side of the market, if you're looking from a longer term approach, and when I say long term, I'm saying 4 years plus, is because of where things have gone in terms of monetary policy. So they've kind of leveled everything off, or in some cases, it's even gone down a little bit. So this gives people an opportunity for things to come back around, right? Like when you start getting involved in something now, and let's say we're just purchasing a piece of land and we still have to go through the zoning and entitlements, we still have to do the pre-sales, the construction, as well as the occupancy, that's leaving 5 years down the line. Now, the reality is a lot of people coming in and people who are here already and in a renting situation, what's happened over the last 2 years has really pushed people to the sideline. Now, the money is sitting there and it's waiting. It hasn't gone anywhere, but we're waiting for the right opportunity for people to actually spend the money to be able to buy something. So when you get involved in these type of projects and you're looking 5 years down the line, we should be in a different situation than what we've been in. Even right now, I mean, I'm not as optimistic as some saying that interest rates are going to start going down as early as June. To me, probably more going into next year is the reality of it. And it's really just because if they go hard, fast the other direction, then we're just going to be taking away all of the efforts that we've been waiting for and what people have been putting up with this high interest rate environment moving into the future. So there's a lot of opportunity on that side if you're looking to get involved in development. And that's one of the corners of the market that we're focusing on right now, is buying land in the most opportune places and giving people the opportunity to invest in these long term. And when you're looking at these from a long term perspective, some of our investment opportunities on that side are looking at upwards of 20% average annual returns if you could lock your money up for, let's say, 4 or 5 years. So at the end of it, you'll get a payout of, let's say, 80 to 100% of what you invest today if you can wait. With that being said, we go back to what's happening right now. And right now, it maybe not be the best situation for people to start buying because we're not coming down yet. That's going to be happening. We don't know exactly what that's going to look like. So that goes back to the rental side of it, which we were alluding to before. We currently have what we call it the apartment fund for short. It's really the technical term is the residential income fund is what we call it here. And that's just focusing on the rental side. In that portfolio, we currently own 35 different buildings that are worth roughly $1 billion. And we manage about 2,800 doors. Now, our biggest asset within it is hitting those upper numbers like we were just talking about, even a little higher, about 360 units. I really, really like that for the short to midterm. When I say that, I'm talking, let's say, the 3 to 5 year mark rather than the over 5 year mark. And the reason why I like that is because of all the things we were just talking about with immigration. Like, regardless if people are coming in at the pace that they're at, when you don't even take into consideration the short-term nature of student as well as work visas, we're looking permanent residents here. The reality is, as a country, we have a very big problem, let's call it, with the bureaucratic process or the red tape that we have to go through in order to get these off the ground. And typically when you're doing zoning and permitting, that's what I'm talking about. That's a 2-3 year process. So you can't just flip a switch and all of a sudden we're building as fast as we can, right? And because of that, that's an opportunity for the rental market, because even if we do want to do that, it's going to take years. And people coming in, again, we alluded to them being in a rental situation in the beginning. That's putting a lot of pressure on it. So we're actually seeing record low vacancies. Across the country, we have roughly a 1.5% vacancy rate, which is the lowest that it's been in roughly a decade or more. Not to mention, our portfolio is a little under 1%. So we're doing a little bit better than the average. But what that does is it continually has people renting, paying their rent over time. So these type of assets, the way they're valued, remember we were talking about net operating income. If you have people in, there's competition that's driving rental prices up. As you have regular turnover within your buildings, you see an opportunity to renovate, bring those up to market again. And the ESG initiatives, a lot of people say that's more of a marketing stunt. I disagree, because especially with the technology that we have today, you can really reduce the consumption of each one of those units. And when you're doing that hundreds of units over the course of a few years, when you own a building, you're seeing the operating costs go down, the rental income come up, and that's actually making these buildings worth more money over time. And that's one of the reasons why somebody like an Equiton, who has the let's call it awareness within it, we know what we're looking for, we have the relationships and the know-how to do these type of things, that we've been able to provide really good returns for our investors. As an example, through this interest rate hike, let's call it, and even just a little bit beyond that, because I'm going to say 3-year average in our apartment fund, we've averaged almost 12% per year for our investors. Now, if people are buying right now and they're renting out, what I'm hearing a lot from the market, and I'll let you touch on this, Patrick, after, because I know that you're really involved in this. What people have been telling me is that they're actually paying money rather than them cash flowing every month. They're paying money out of their pocket. And right now, the appreciated value isn't going up as fast as you would want it to. So you're making this shorter term investment into a longer term investment just based off what market conditions are telling you at this point.
Well, there's a lot to unpack in all of what you said, but let me see if I can kind of bring it down into bite-sized piece. First and foremost, when you look at a lot of things that you talked about and you mentioned, first and foremost, Equiton's got $1 billion plus of assets under management. You've got a management team, you've got experience, you've got relationships. So that's that side of the equation. The other side of the equation is, to your point, is a lot of independent investors right now, in small mom and pop type investors, which is really the world that we've lived in for many, many years, are losing the opportunity to be able to buy and cash flow. Interest rates have taken them out of the market. The supply has been a big challenge, and then on top of the supply challenge, it's like, can this piece of property work? So even with the few properties that are coming in, it's even fewer that make sense in terms of a cash flow. We look at the immigration coming in, we look at the demand, and we look at the lower vacancy rate, the increasing rents that are happening in spite of what's happening with landlord-tenant rules. British Columbia just went totally south on that whole plan, by the way, or they're about to go south. We'll get into that another time. But the point of all of it is that when you look at what we're investing in real estate for, we have to understand we're trying to stay ahead of the inflation curve. Now, you may buy precious metals, you may buy Bitcoin or some kind of cryptocurrency, but when we look at real estate as another part of, or another piece of the foundation of whatever portfolio you're trying to build, real estate is a big deal and a huge opportunity in Canada if you can get in the game. Harder and harder to get in the game, given the rates, given the lack of supply. And back to what we've been talking about really here is the opportunity that Equiton presents because of what you can enter the game at in these multifamily units and buying into a much bigger project. You're not qualifying for mortgage. You're not having to come up with tens or hundreds of thousands of dollars. You're not waiting for CMHC.
It's kind of the point of companies like Equiton, right? Like what we're doing is we're trying to help everyday Canadians be able to invest and profit off of real estate without having to do it on their own. Really, the structure of our fund, I think, is worth just going over really quick because it explains it. Essentially, what we did is we opened up a mutual fund trust, okay? And the reason why we opened it as a mutual fund trust is because that's the structure alone that allows us to take people's registered monies. So even if you don't have cash, you just got a mutual fund sitting in a LIRA or a TFSA or RRSP that's been doing nothing over the last few years. You can even use those type of monies. But regardless, what we do is we sell units of a trust to individual investors. What that does is it gives them a small ownership in the portfolio as a whole. because those 35 different buildings are owned by the trust. So technically, our investors actually own these buildings. So what we're doing is we're just pooling a ton of investors' capital together so that we can do this on a large scale for them.
Yeah.
Now, Equiton comes into the pictures. We're just asset managers. So we are the experts. We're the ones running due diligence, doing proper financial forecasting, finding tenants, dealing with everything on that side to make it passive in nature so that you can get the really good returns that are associated with real estate, again, without having to do it on your own.
Mm-hmm.
And the next layer with something that you said specifically is qualifying and paying those big down payments. To get in the game now, you got to have hundreds of thousands of dollars. You got to have really good credit. You got to have a lot of things going for you. Yeah. With us, we can take as low as a $5,000 minimum investment for some of our portfolios, and the highest one of our portfolios minimum is $25,000. So for pennies on the dollar, let's call it, of what it would cost you to get involved in the game, you can get involved here, and all of your risk is only tied to your original capital. You can never lose more than what you actually gave. So it's a piece of the pie, essentially.
So I'm going to wind this down, but Kyle, I think that we have to stress something fundamental here, is that when we look at real estate overall, if you're going to get in the game, and it really is about how you play the game now. We know that real estate is the game to play. When we look at all of the data, all of what's happening with, again, immigration and supply and what the demand is on that side of the equation, real estate is a place to put your capital to work to stay ahead of what's happening. We partner, within the Real Estate Investment Network, we partner with an Equiton because it opens up the door of opportunity to get in the game and play the game, put your capital to work, risk mitigate, get great returns, and understanding that the fundamentals of why real estate works continues to work. And if anything, I get more optimistic as we see what is happening in a global economic or a geopolitical world and a global economic world. When we look at interest rates, and I know you're talking about interest rates into 2024. I'm with you. I see maybe a small decrease near the end of 2024. I think you're talking about next year. What I'm looking at and going, if you're going to buy real estate yourself, you're going to get in the game yourself, then just be prepared to do the math over a couple of years, because I think it's going to be a good solid 2 years before we start to see rates come back to a place that makes sense to us as investors, that's going to actually give us a good lift on the cash flow. And I'll leave the last words to you, Kyle. Anything you want to add before we sign off?
Honestly, I think you hit those points right on. The risk mitigation, the making sure that you're running proper financial forecasting, make sure that you're looking at the trends, what's happening. Don't be overly optimistic, but know what's going on so that you can pull the trigger when the time makes sense. And just having an overall thought process of trying to keep your money ahead of inflation, because that's what it's all about.
Fantastic. Kyle, thanks for joining me today. Thanks for that update. Folks, make sure you're reaching out to Equiton. Reach out to Kyle himself. His whole team will cover you, but ultimately get in touch, find out more about it, get your capital to work. Don't miss this opportunity for investing in real estate in this fashion. This is a way to get your capital to work. Kyle, thanks for your time.
Thanks so much, Patrick. It's always a pleasure to join you guys. And until the next time.